Welcome to Trust Tactics, a video series that explains the structural advantages investment trusts have over open-ended funds and how private investors can take advantage. My name is Caldwell and I am Deputy Editor of Money Observer. Every year, millions of people decide to outsource the investment decision making to a professional investor, known as a fund manager. That fund manager will then invest your money alongside that of other investors in a selection of stocks, known as a portfolio. For instance, a UK fund may own the likes of Tesco, BP and Vodafone as part of their portfolio. The fund manager will either manage an open-ended fund or an investment trust. The main difference between the two is that investment trusts are companies in their own right and are listed on the London Stock Exchange. So you're not just a fund investor, you are also a shareholder. Investment trusts have certain structural advantages over open-ended funds, which I'll be explaining in more detail later on in this video series. But to start off with, here's a quick taster of the 5 main reasons why investment trusts have the edge. Firstly, there's the opportunity to pick up a bargain. Investment trusts have 2 values: how much the trust holdings themselves are worth, their net asset value, and the price its shares trade on the stock market. Investment trusts that are currently in high demand may well trade on a share price premium to net asset value. This means that investors are paying more than the assets are worth. A discount, on the other hand, as the name implies, offers investors the chance to buy the shares on the cheap. The dividend reserves. Unlike open-ended funds, investment trusts don't have to distribute all of the income they generate every single year. They can hold back up to 15% every year, so therefore can build up a reserve to bolster dividends in leaner years. Many of them also make a point of increasing their dividends every year. The third advantage is the fixed pool of assets. Unlike open-ended funds, investment trust managers do not have to sell or buy assets, depending on whether the trust is attracting or losing investors. Because those investors are buying or selling shares on the stock market. The ability to gear. Again, unlike open-ended funds, investment trusts are allowed to gear or borrow to invest. This can improve their performance in a rising market, but it does increase risk. And finally, there's the board of directors. An independent board of directors oversees an investment trust and ensure it is managed according to shareholders' interests. If the fund manager doesn't do a good job, they can be fired and the board can replace them.